Hey everyone, welcome to SumZero. Today we are chatting with Ted Rosenthal. He runs a fund called TMR Capital, which he started out of college 4 years ago. And Ted focuses on a lot of stuff that's a little off the run, special situations investing, focus on equities, long short, and I think is does a lot of work that we at SumZero love. So Ted, with that, thanks for joining us. Do you want to just give listeners a little bit more color on where you see opportunities in the market and how you've kind of positioned your fund?
Yeah, absolutely. So thank you for having me. The biggest opportunities I see in the market today on the long side are in the following categories. So one, fast growing but currently unprofitable consumer and tech companies. So there's been an extreme sentiment change there over the past several years. And you can, if you want like a proxy ETF, you can look at the ARK, for example, ARKK. And so now a lot of these companies have unsustainable business models, poor unit economics, but there's also been babies that have been thrown out with the bathwater. And so just picking over some of those, trying to find companies that have had huge drawdowns, but that have unit economics that make sense and that can continue to grow. So that's one area that's been interesting recently on the lawn side. Another area are small caps, are just really small companies. So there's various charts that show like how small caps have underperformed large caps over the past decade. And if you think that the current bubble that we had was similar to, say, the internet bubble, then post-internet bubble, the S&P went down something like 15% over the next 2 to 3 years, but small caps went up 100%. And so I think there's a similar setup today. And so, I mean, I do bottoms up analysis, one name at a time, but just that's where I'm finding a lot of opportunity. And then I can also, there's some of these companies have less coverage. So I can invest in these companies and then try and share them with the broader investment community.
Yeah, that makes a lot of sense. Certainly in small caps, people don't really follow a lot of companies and know them well. They don't get a lot of coverage, not only by the sell side, but also by the media. Tell us about Zenvia Inc. I know that's one of your names. How did it come across your radar? And if you could just walk through the thesis, that'd be very helpful.
Yeah, so Zenvia, they are the world's cheapest enterprise software company with over $100 million of revenue. And so they IPO'd in, I think, 2021. They had about $750 million market cap. And now they're roughly $50-60 million market cap. So I've gotten involved recently. I discovered it from my trips to San Francisco. So I spend about half the year there just being more involved in like the startup ecosystem. So I met with two startups that are in communications platform as a service, which is what Zenvia does. And so they pointed me to like Twilio, Zenvia, a few others. So that's how I initially found it. So Zenvia, the reason why they've had the huge drawdown, Zenvia is basically a case of like good business, bad balance sheet. But in this case, it's not so much the balance sheet because they're at a net cash position. It's the amount of earnout obligations that they have. So just a brief background on Zenvia. They started off just doing communications platform as a service. So like think like voice, SMS for small and medium businesses. And then in 2021, Zenvia wanted to diversify by buying up several enterprise software companies. So now you can think of Zenvia as like the Twilio of Brazil, and then also like the Salesforce, Zendesk of Brazil, just to make that analogy. And in making those acquisitions, Zenvia incurred significant earnout obligations. Like these are basically founders waiting to get paid for the company that they've acquired. And Zenvia planned to do a follow-on offering post their IPO to raise additional capital to meet those earnout obligations. However, in 2022, the capital markets shut, especially for companies like Zenvia, and so they were not able to do that follow-on offering. And so investors basically like did the math. They looked at the balance sheet. They looked at the amount of obligations they would have to do like from the earnouts, and they thought that Zenvia would go bankrupt. And so that's why the stock went from $750 million market cap to a low of about $30 million market cap. And now it's about a $50-60 million market cap. So that's where we're at now with Zenvia. And the reason why I find it interesting is because I think through my conversations with people involved with Zenvia, I believe that the funding gap has been resolved pretty much, and so there should be 20x upside. So that's a huge amount of upside. And the reason why I think the funding gap has been resolved is because Zenvia has successfully pushed out their earnout obligations. It's like they might have had one lump sum of, say, $50 million or whatever, and they've been able to push that out over a number of years. So successfully negotiated that way, but then also just through boosting the EBITDA and the free cash flow generation.
That's really interesting. Can you go into detail on what their profitability looks like? You mentioned $100 million in sales, but how is that flowing through the income statement?
Yeah, so EBITDA, so Zenvia's, they're projected to do about $160 million of revenue in 2023. They've historically grown the revenue at 20-30%, and they've actually been EBITDA positive every single year except for 2022. And part of that is the way the history of Zenvia. So Zenvia, it's still run by the founder, Kezio Bobson, and he bootstrapped this business in his garage about 18 years ago. And so there's always been that mindset of being lean and profitable. And then also one other thing to note is that there's virtually no stock-based comp expense with Zenvia, which is unlike most enterprise software companies that might have 15 to 20% of the revenue in stock-based comp. So they've been pretty good with that. And so they're projected to do 70 million Brazilian reals, that's their currency, of EBITDA this year. And so they're on track to meet that. And I think that longer term EBITDA margins can inflect back to 17-18% margins, which is in line with what they've been doing just a few years ago. And then in terms of free cash flow, so there's a few interesting things to note on free cash flow. Zenvia has been able to unlock a lot of free cash flow through operating working capital, and that's through two key drivers. One is through accelerating their accounts receivables. So Twilio, which is a large enterprise software company in the US, Twilio owns 10% of Zenvia stock, and Twilio has basically agreed to pay Zenvia sooner, to accelerate those accounts receivable. So that's one lever. The second lever is negotiating with the telcos. So this is basically extending their accounts payable for Zenvia, which is also a source of cash. And so Zenvia plus Twilio in Brazil, they're like 60% of the purchasing volume of SMS from the telcos. And so Zenvia is the number one player by scale in Brazil in communications platform as a service, and they have a lot of negotiating leverage. And so they've been able to push out they've been able to extend payments from the telco. So you add those two combined, that has unlocked already $40 million of additional free cash flow just from those changes in operating working capital. And so now there's about $60 million of total earnouts left, but those earnouts are extended until 2026. So EBITDA and then operating working capital.
This is the Twilio of Brazil? Is that an oversimplified way of thinking about this?
Yeah, so about half of the gross profits, when they IPO'd, you would have said this is the Twilio of Brazil, but now because they're also in enterprise software, like the gross profit, about half of it is from enterprise software. So now it's better to just say it's the Twilio / Salesforce of Brazil.
Interesting. What would you say? I mean, when you look at like the relevant metrics here, like what are the most important metrics you're looking at to judge the business by?
Yeah, it's still enterprise software. So you could look at like the number of customers, the average revenue per user, etc. Like you traditional enterprise software metrics.
And in terms of, like, let's say EV to sales, I mean, it sounds like what you're telling me is that they're trading at roughly like a 0.5 EV to sales multiple. Is that where they're at?
0.18.
Oh, 0.18.
Yeah, EV to sales. It depends.
Okay.
Like if you look at next 12 month, like I usually for my multiples, I just do next 12-month revenue consensus forecast. So that's about 0.18.
You're saying that's 130, 140? What was the the next 12-month revenue number?
It's about $160 million projected in 2023. Yeah,
Oh,
100 projected revenue in 2023.
got it. And what is the enterprise value of the business
So
now?
the enterprise value, I'm looking at it live now. It's $55 million enterprise value and $57 million market cap.
Okay, so it's closer to a third, but still, now in Brazil, what are there comps that are relevant here that you would compare that to? Like what are you comping that against?
Not really in Brazil, but I guess generally enterprise software, there's two sets of comps. One is communications platform as a service, and the other ones would be your more traditional enterprise software like Salesforce. And so like the communication platform as a service, that's going to be a lower revenue multiple because that's a lower margin business. So like Twilio, I think trades at something like 2x revenue, but they've derated a lot. So maybe 3 to 4 times revenue is in a more normalized environment. And then for enterprise software, Salesforce, I think trades at about 10x revenue. Let's see. Yeah.
That's
Well,
about
they're
right. I mean,
6x revenue now,
yeah.
but in a more normalized environment, that'd be 10x.
And is your view that so when you think about the Brazil exposure, I mean, I'm assuming you're discounting like normal multiples somewhat just by virtue of it
Yeah,
being
yeah,
Brazil.
yeah,
You,
absolutely. You can absolutely discount that for to account for the macro with Brazil. But even whatever discount you want to use, even still.
yeah, you see it as super cheap.
Yeah.
And you mentioned you discovered the company on your trips to San Francisco.
Yeah.
Have you been able to do any sort of primary research or channel checks on their current state of business to sanity check, some of the growth numbers that you've assumed for the following year? Like, have you been able to get hold of customers by any or kind of competitive offerings or anything to get some color on how their business is tracking?
Yeah, so for Zenvia, the business has never been an issue. And so I haven't really spent much time trying to talk to like small, medium businesses. What I spent more time was on the funding gap because that's the main
Mhm.
reason, that's the reason why they derated so much. So I spoke with a board member on Zenvia who's also a partner at Oria Capital. Oria Capital is a tech PVC firm in Brazil, and so they're an early backer of Zenvia, and they're still a significant shareholder. So I just talked with him to better understand the funding gap, like what discussions they were having with banks. I know last year they were entertaining discussions with distressed hedge funds, but they never did anything with them, and they're not having those discussions anymore. So the situation was a lot more dire last year, but now there's a lot more visibility into the business and the forecast and everything, and the funding gap is, in my view, it's pretty much resolved. They've extended it so much, and they have all these levers to boost free cash flow.
What are the catalysts that you see coming?
Yeah, the main catalyst is the resolution of the funding gap. So that can either be on its own, just through continued EBITDA and free cash flow growth, or it could be through some kind of capital markets transaction, perhaps like some kind of deal in the private credit markets that gives Zenvia more breathing room, but that doesn't dilute shareholders. Well,
Um,
and also just continuing, like they've already done the hard part of extending those earnout obligations.
you mentioned that Twilio was an owner of
Yeah,
Zenvia. Is
yeah.
there any um, technology transfer between those two companies? I mean, does Zenvia license anything from Twilio? Do you know if Twilio has any, like, what are their plans to do with their stake in Zenvia? Any color on that?
Yeah, I mean, it's a strategic investment from Twilio, and so they do have an agreement where they basically do business with each other, and it's beneficial to both Zenvia and Twilio.
What are the risks to your thesis, in your opinion?
Yeah, so the risk is mostly related to the funding gap. So if basically if the holders of the earnout obligations want to see Zenvia, like, they want to be more aggressive, which could push Zenvia into bankruptcy. Like, for example, they wanted to try and accelerate their earnout obligations, but that's not that I mean, the biggest thing is the funding gap, which relates to those earnout obligations. And so that, but that's not what's been happening. Like, they've been able to extend it, and there's risk related to the business as well, but that's like that's not the reason why the stock is down so much. So I would say, like, you need to focus on the funding gap. That's the biggest issue that investors need to get comfortable with.
Okay. Moving on, I think you wanted to talk about Harrow, so
Yeah.
give us the quick overview there as well. And just if you can just tell listeners what the ticker is, market cap, kind of basic information, basic trading status.
Yeah. So Harrow, HROW. So they have just shy of a $500 million market cap. So basically small cap pharma. And Harrow, the basic thesis is that I think Harrow can become the leading eye care pharmaceutical company with over $1 billion of revenue and 30% plus operating margins over the next 5 years. And the market is basically not giving Harrow any credit for that. So Harrow is both a compounding pharmaceutical business, and then they also have FDA approved products that they're dropping into their distribution platform. And so the market is valuing Harrow at about 10 times EBITDA, which is basically they're just thinking about the compounding pharmaceutical business, and they're not giving any credit for the growth potential of dropping down those FDA approved products. So that's the thesis in a nutshell.
Where do they operate?
So it's US. Harrow's US based.
Got it. And how did you find that stock? What was that, a screen, or was that another personal introduction?
Harrow was just through my conversations with another investor who runs about a $20 million hedge fund. So like more he's focused on more niche, like off the beaten path opportunities. So just speak with him.
Yeah, I mean, it sounds like Harrow is I mean, at least versus Zenvia, like a much simpler, maybe just kind of like a longer term hold where earnings becomes the catalyst if they can compound, and then there's some product pipeline that could add some extra juice to the story. Is that?
Yeah, so Harrow is simpler in that sense. They don't have like a funding gap or a balance sheet issue with Harrow. So there's like virtually no sell side coverage, and there's pretty much no buy side interest. Like I was the first person to post Harrow on both SumZero, Value Investors Club, like your typical idea sharing websites, and so there's limited interest, and so I just wanted to highlight that the market is completely underestimating, or maybe not paying enough attention to the FDA approved products that Harrow can drop into their platform. And so I just to level set. So they have the compounding pharmaceutical business, which is basically Imprimis RX, and that does about $80 million or so of revenue. They built that from pretty much nothing in 2014, and they're in 1 out of 5. So about 20% market share for cataract surgeries. And now Harrow has FDA approved products that they can drop in their existing distribution platform. So for example, HROW, which is basically a gel for eye surgeries, they just launched that in early this year. And so like I've done checks with physicians, and they're basically, and you can also look at like Bloomberg sales data. So that has really strong traction, and that's like one of the revenue buckets. they have basically 5 revenue buckets. Each one has the potential to do 9 figures. So if you add those 5 revenue buckets, you get to that's how you get to $1 billion of revenue. And so HROW alone could be a $400 million plus business. And so there's several of like these kinds of drugs where like they already have the FDA approval, patent and everything. It's just a matter of executing.
Yeah, that's it. It almost sounds like they've got there's a lot of free option value in the stock.
Yeah, there's a lot of different ways to win here.
And in terms of the current valuation, you said 10 times EBITDA?
About 10 times EBITDA.
Do you know anything about the management team there? That's worth noting? Anything about the founders or investors? I don't know if you have any color on that.
So it's run by the co-founder, Mark L. Baum, so owner operator, and he owns a significant stake in Harrow. So that's to note there. And so this basically he's built this business, and he's a serial entrepreneur. And then in terms of the shareholders, so I spoke with 2 shareholders. There's one large healthcare hedge fund. So I think about close to $500 million of AUM. So this is their second largest position. And then there's another investor I met on SumZero.
Yeah. What does sell side coverage look like for this name? Are there any
there's 3, I think there's 3 firms that cover Harrow. Let me just get their names. So there's B. Riley, there's Ladenburg Thalmann, and then there's Lake Street Capital Markets Research.
Yeah, I haven't heard of the latter 2, but that's not a surprise. What's the downside in this name?
So the downside is that the new FDA drugs don't get the traction that management that I expect. It's like, for example, HROW, Trucians, VEVI, they just don't, like, whether it be like adoption by physicians or issues with like reimbursements or whatnot, they don't get any traction. But the market's not pricing in that growth anyway. And then on the compounded pharmaceutical side, that business to me is a lot more dominant. So I don't think there's as much risk over there. So it's mostly on the new drugs, on the growth. Like maybe there's not as much upside as I think, as opposed to like there being a lot of downside for this stock.
Do you have any macro thoughts at all? Or I don't know if macro is part of your process at all, but just given the interest rate environment we're in, do you have a sense of how sensitive some of these names are to rates, or maybe a recession scenario if that were to occur? Any thoughts on that?
So for Harrow and healthcare, I don't really see it being super sensitive to macro, because like people have eye problems, they get surgery and they want like for adhesive, they want a cream, an aesthetic that works. Like existing solutions, speaking with physicians, some of the existing solutions, they have to use a lot of different kinds of anesthetics. So it's like various kinds of point solutions, and then sometimes like the gel like wears off, and so like they feel bad after the surgery. But with the HROW, the consumers have said that they feel better after they get the kind of eye surgery, and so that's they still need that regardless of what's going on with the macro over there. And then for Zenvia, they would be more macro sensitive because a lot of the customers are small and medium businesses, and communications platform as a service, that revenue is based on usage as opposed to like your enterprise software, which is recurring contracts. And so so Zenvia would be more sensitive to the macro.
But correct me if I'm wrong, Zenvia has fallen a lot more than Harrow has over the last months. Yeah. So maybe some of that's priced in.
Well, Zenvia's priced like it's going bankrupt. which is
Right.
basically, but that was last year's issue. Like this year is more like this is a micro cap, it's illiquid, and you know, gotta get more coverage of Zenvia.
Is the balance sheet with Harrow pretty clean, or what's the balance sheet look like over there?
Yeah, they've got some debt, but I haven't. I mean, I think it's fine basically for Harrow, and they're also they're inflecting towards profitability. So
Hmm.
they're making money. So they're generating free cash flow now.
Yeah, Ted, this is great. I think we love small caps at SumZero. It's not every day we get like a micro cap, something that's fallen 90% or whatever it has with Zenvia.
Well,
Um,
revenue wise, it's not a microcap.
right, right, right,
Yeah,
right. Which
it's
I
it's
think
it's a
makes
fully scaled, $100+ million in business.
yeah, yeah. I mean, it's exciting to watch because I think you described it as a 20x.
Yeah,
If,
yeah,
if you're right on your thesis, I mean, what would
yeah.
you say the upside is
I mean, I'm
with?
I'm underwriting Zenvia at like 12, 15 times EBITDA, and that's about 5 times revenue. That's like a blue sky scenario.
Got it. And with Harrow, what do you think the upside there is?
So with Harrow, so assuming that they can do, $1 billion of revenue, 30% operating margins, and 12 times EBITDA, so that's within the next 5 years, then that's about 750% upside, so about 60% internal rate of return.
Love it. Swinging for the fences.
Yeah,
That's what it's all about. Ted, thanks for joining us on SumZero. Well, I'll certainly be following both of those names, and we look forward to seeing more of your analysis on SumZero.
thanks so much for having me.
All right. Thanks, Ted.